All right, how's it going, everyone? Welcome to part 2 of a former strategy guide. I used to work for a pharmaceutical company, analyzing and breaking down the pharmaceutical space. So picking up where we left off, let's go ahead and talk about number 1, Eli Lilly. And when I say number 1, I'm not saying in my own heart. I'm saying they have the biggest market capitalization. It's almost at $1 trillion. That's pretty crazy, okay? Ticker symbol LLY. Past 1 year, it's going to be ridiculous. 46% into the green. That is outrageous. Past 5 years, 662% into the green. Let's take a look at their financials. It's going to be a beautiful picture. I'm warning you, okay? Currently trading for about $1,100 a share. Now, friends and family, where we left off with Pfizer, I was upset. I was repulsed. I was disgusted. When we look at Eli Lilly's revenue situation, their top line, this is phenomenal. I mean, I would argue leading up to 2023, it was very modest. At a mid-single digit growth year over year. But ever since they've rolled out their own Ozempic, their GLP-1 drug to help weight loss and to curb any addictions, their revenue has just been exploding. So I'm a huge fan of what I see. Scroll down to take a look at their profits per share. It should be just as juicy. My goodness gracious. I mean, that one weird year right here, 2017, negative 19 cents of bottom line per share. Other than that, not bad. I mean, the trend, pretty much in line with other pharmaceutical companies, their profits are always going to be volatile. But if it's going to be volatile, it better still be trending in the right direction in the grand scheme of things. And is that the case? 2015, we're talking about $2.26 of profits per share. Now we're talking about $20.44. That's they amplified their bottom line to the point where I can't even make fun of them. That is phenomenal. And no, I'm not invested into them. I'm not invested into any pharmaceutical stock because I refuse to invest into the pharmaceutical space, understanding the landscape. And that's why in this video, I'm trying to tell you, if I had to, which one would I invest into, right? Jumping on over to their balance sheet. Oof. It was a pretty hideous situation leading up to 2024, and that's because I'm assuming they were spending a crap ton of money to make a response to Novo Nordisk's Ozempic. And now that they have answered that challenge, now the cash on the books, it's back to normal, and it's, I would argue, even healthy. 181% increase year over year. 181% increase. What's their debt situation? Total debt is $42 billion, but the best way to take a look at a company's debt situation to see if it's manageable or not is a debt to EBITDA ratio. Basically, you're taking their core operating profits and you're baking in how long it would take for them to pay off their loans if nothing else were to change. The golden ratio is a 3 or below. For Eli Lilly, we're talking about a 1.4. So it would take them 1.5 years to pay off all of their loans. I would argue that's not bad at all. Take a look at their free cash flow. $10 and 500% increase in the past 12 months. That is just an outrageous growth. Now, obviously, I'm not a fan of what happened in 2023, but in the grand scheme of things, that's what I like to see, the trend, right? 2015, $1.8 billion of free cash flow, $9.2 billion of free cash flow, and I'm assuming it's going to get even better. So if we jump on over to their dividend profile, I know, I hear you. It's nothing to write home about. It's the exact same dividend yield that you'll see out of PayPal, Google, Microsoft, out of the Max 7. But the growth rate of 15%? Dude, you better take me out to dinner if you're going to make me lactate like that. A 15% growth rate in the dividend? Dude, sign me up. I don't care who you are. As long as you're not racist, sign me up. Dude, I'm on board. That's phenomenal. And they've been growing their dividend for the past 10 years. Payout ratio, absolutely healthy and sustainable. There's so much to like about Eli Lilly. The only thing that makes me hesitate is their valuation. Right now, their PE is a 54, which is a little high, but given that they're growing their numbers at an outrageous rate, I could see why Wall Street's feeling pretty bullish about them. And something else to take into consideration is when we take a look at their drug and vaccine pipeline, it's looking pretty good. The pending drugs that are about to get rolled out, it's best in class. Their future looks pretty darn bright. And as of right now, they're the market leaders for type 2 diabetes, and their Zepbound weight loss drug, not only is it for people to shed the weight, but it's also going to help them curb any addictions, including gambling, watching graphic images, or even smoking. So it's a game changer beyond belief. So when you think about Eli Lilly, things are looking pretty good. In case you did not watch part 1, I would encourage you to do so. Let's just do a quick refresher. So for a drug, a vaccine, a pill, or a treatment plan to roll out into the masses, it has to go through the proper steps. And this is what we refer to in the pharmaceutical space as the pipeline. Every single drug begins with R&D, figuring out there's a need for this treatment because someone is suffering from fill-in-the-blank illness, virus, disease. So the scientists, researchers, they'll go to work and start developing the compounds or the mechanisms that will reverse the effects of said problem. And once they get it fortified and they start experimenting, that's when it rolls into phase 1. And I'm going to tell you right now, most drugs and vaccines will never make it to phase 2. Almost every single one of them will fail and die in phase 1, because that's where it begins with the small amount of human trials. So it's going to be a small sample group, and if it's not overwhelmingly successful, it's going to fail. And what I just said, what makes it even crazier is to consider the fact that it takes millions of dollars to even get to phase 1. Because think about all of those scientists and researchers that are on the books developing that drug that may or may not pan out. So let's assume everything works out, it's safe, and they figure out the dosage. It goes on to phase 2. This is where they really test for the effectiveness of the said vaccine or drug. So they'll bring in even more people that have the disease, virus, or illness, and it has to be an overwhelming success. Now, if so, they'll make it into phase 3. Now, this is what everyone refers to as like the clinical trials, but the fact of the matter is phase 1, phase 2, and phase 3 are clinical trials. But phase 3 is when they make it a more of an emphasis and the pressure cooker is on. They feel the stress. Because once you make it to phase 1 and phase 2 and phase 3, it's like, dude, you're almost there. You're almost at the finish line and going to market with that drug. Now, what makes Eli Lilly very different from Pfizer, which is the company that we last talked about in part 1, is their pipeline success rate. In phase 3, only 1 failed, which means they're going all the way back to square one to figure out what the heck happened and how can we go through phase 1, phase 2, phase 3 better next time. Everything else seems to be doing okay. I would argue almost every single one of these should have a red arrow saying removal, failure, setback. But to see a lot of green arrows in phase 3, I'm telling you, dude, the future looks really bright for Eli Lilly. And then, of course, the last one is the regulatory review. Once you're in this point, you're just hashing out the profits, the margins, the marketing plan, how much you're going to charge and whatnot with the government and the regulatory agencies. Once you're in this step right here, you're basically going to roll it out. But again, just in case you're not paying attention, at any point, no matter how much money a pharmaceutical company has spent, a drug, vaccine, or treatment plan, it can fail in any one of these phases. And they're just going to have to eat that cost or scrap it or start all over. That is something to be wary of. And I think Eli Lilly's strong drug pipeline is a huge reason as to why they're seeing such a success in the stock market. Whereas on the other hand, with Pfizer, dude, their pipeline is really rough. Anyways, let's move on down to Johnson & Johnson. Second company on this list, ticker symbol J&J, past 1 year, what are we working with? They're at their all-time high for the past 365 days, effectively $207 a share. Past 5 years, they're at their 5-year high. Now, what I like about J&J is that they're not just selling pills and medicine. They also have a medical device arm of the business. So they're not just dependent on the drugs and vaccines. Their revenue is more diversified. And prior to the spinoff with Kenvue, they also were the parent company of Band-Aid, Neutrogena, and some other consumer health products. So J&J, pretty high quality, but they're also very famously known for a lot of scandals, lawsuits, and regulatory probing. So it's a double-edged sword when it comes to them. But when we hop on over to their financial statements, take a look at their top line, I mean, this is immaculate, right? Just slowly and inevitably, it's just growing year after year. The drop off right here is because of the Kenvue spinoff. So once they lost the revenue attributed towards Band-Aid and Tylenol, I mean, it took a pretty big drop, right? What is that? Negative 4.6% year over year, but they picked it back up and it's as if nothing happened. So in the grand scheme of things, to lose a huge chunk of your business and to still be thriving, dude, you have to give props where props is due. That is really impressive. Scroll on down, take a look at their bottom line per share. It fluctuates, it's volatile. That's characteristic of the pharmaceutical space. So I'm not gonna slap them in the face for that. What I want to see is a trend that's going in the right direction. And the reason why their profits went through the roof in 2023 is they're one of the big three or big four that developed a COVID-19 vaccine. And that's why their profits were just exploded in 2023. $10.35. It's pretty good. And before we talk about their cash flow statement, J&J, as of right now, they're the market leader for drugs that are related to Crohn's disease, psoriasis, and very, very unique and rare cancers. So they carved out a space where they're best in class. They're not even trying to compete with Eli Lilly and Ozempic, because you're going to have to spend like $50 million that may or may not pan out. Instead, they're trying to figure out solutions to problems that affect millions of people. So I think it just speaks volumes about their leadership team. So taking a look at their free cash flow per share, going from $5.81 in 2016 to $8.14, it's pretty good. Let's just jump on over to their dividend profile. A 2.5% dividend yield. Growth rate is just modest. Well, actually, it's good. Because for me, the golden standard is 3% or better, which keeps up with the rate of inflation. That way, your purchasing power of the income that you get from the passive dividends, it keeps up, right? Because the value of $1 today, it's not going to be the same $1 10 years from now. So you have to see dividend growth. That's just my personal opinion. And that's why I'm a dividend growth investor. I think everything here checks out. This is what is really amazing, though. 63 years of growing their dividend, which means during setbacks, during recessions, during catastrophic events, they do not cut their dividend. In fact, they grow their dividend. And I remember in 2020, the payout ratio was ridiculously high, but the leadership team was like, dude, we're going to stay committed to growing the dividend. And they did. And now, fast forward 5 years down the road, the payout ratio is back down to 49%. Amos, what does 49% mean? That means out of their profits, in an accounting measure, 49% of it is allocated towards the dividends, which means they have 50% of their profits left over to reinvest back into the business, to do R&D, to increase the wages of their staff, and so forth. And that's why lower the payout ratio, the better it is, because it gives the company more flexibility to handle setbacks. Because if you're at 99%, if somebody comes into the building and lets out a small fart, that could be the end of it. You could collapse. But if you have 50% of your profits going back into your pockets, if you have a setback or litigation stuff that J&J deals with, you have the money to deal with it. Just my take. So overall, with J&J, I like what I see. I mean, I think the numbers do the talking, and it's very consistent. All right, circling back to the list of pharmaceutical stocks, let's talk about AbbVie. Now, this is an interesting one because for the longest time, their success was based on their miracle drug Humira, which is a cure-all for the chronic inflammatory conditions like arthritis and psoriasis. However, that patent expired in 2018, and it's been a scramble for them ever since, up until now. So, taking a look at their one-year price, plus 28%. So their scrambling paid off. Because fortunately for AbbVie, they found a revenue boost from their migraine and Botox products. Because when you think about it, at least here in the US, women over the age of 40, if they live in Arizona, Florida, California, or in Salt Lake City, dude, they're paying thousands of dollars per year for Botox. You can thank AbbVie. This is a company that is benefiting from people feeling insecurities and getting cosmetic procedures, right? Fillers, Botox, it's the name of the game. And so if you're bullish on Brian Johnson and the whole anti-aging movement, I think Botox belongs in that conversation. Just all I'm trying to say. Taking a look at their top line, beautiful. It reminds me of Johnson & Johnson. This is exactly what you want to see. It's consistent, it's reliable, it's almost predictable. It's going to go up. I mean, in 2023, it was an off year, negative 6.4%. But they recovered and everything's okay. But this is where it gets pretty rough. Okay, friends and family, for the earnings per share, commonly referred to as the bottom line per share, to be going in the wrong trend in the grand scheme of things, for me, that's a huge deduction. And I would have to do a deep dive to figure out what caused that. Is it because of an asset write-down? Is it because of an acquisition? Is it because of a settlement? It's not good. Taking a look at their balance sheet. Oof, my gosh, in 2019, that was phenomenal. $39 billion, but like, golly, dude, it's, again, going in the wrong trend. Total debt is pretty horrific, $68 billion. But the better way is the debt to EBITDA, a 2.3, so roughly 2 years and like 4 months to pay off all their debt using their core operating profits, which is the EBITDA. Dividend profile, 53 years of growth, 3% dividend yield. Payout ratio is 500%. Hold on. The dividends per share is $6.92, and they grew it by 5.7%. So if the dividend is truly not sustainable, it usually does not grow, or you see even like a growth rate of like 1%. But the fact that they grew it by 5.7%, let's do a deeper dive. So $6.92 for their dividends. The free cash flow per share is a good proxy to figure out the payout ratio. The free cash flow per share is $11.10. So we're going to take $6.92 and divide it by $11.10, and their payout ratio should be around 62%, which is manageable. It's healthy for a pharmaceutical company that's mature, like AbbVie, usually around 50 to 75%. If it gets into the territory of like 90, 95%, like Pfizer, that dividend might not survive. It might get cut. So AbbVie, I think there was some good. I think the good is like the growth rate, the revenue, the top line. Some bads include the earnings per share is just really rough. Up and down, up and down, up and down. Their balance sheet looked kind of rough as well. Their free cash flow, though, looked pretty good. Not too bad, $11.10. It seems to be in the right trend. I mean, I don't like what's been happening since 2022 of falling, but it does seem like they're bouncing back up. I guess in the grand scheme of things, it's going from $4.28 of free cash flow per share to $11.10, so it's good. So I think with AbbVie, I think it's a mixed bag. I think there's some good and bad. It's like a very balanced pharmaceutical company. Past 5 years, you would have 2x your money. I think if you're investing into AbbVie, I can understand, but I think there's better options out here. All right, so for the purposes of this video, let's just move on down to Merck, ticker symbol MRK. I do have a few colleagues who work at Merck. Let's take a look at their 1 year trajectory. It does seem like they had something happen because in the past 1 month, they went up by 20%. Past 5 days, 10%. But they're effectively at their 1 year high at $104 a share. Prior to that, back in September, October, they were like $77. Back in November, $82. So if you jumped in right before they jumped and popped because of Keytruda, which is their bladder cancer drug, it had significant news in the drug pipeline, and it's about to be released to the masses. So the markets are feeling very bullish about that. And for Merck, I think what separates them from the pack is that they focus really heavily on cancer research. So their pipeline is almost entirely dedicated to tumors and everything else involving the intestinal lining. And they also dabble a little bit in vaccines. It's a parent company of Gardasil, which is a vaccine against the HPV. So they're kind of diversified with cancer and vaccines. Lovely situation with their revenues, $39 billion to $64 billion. The growth rate, not the biggest fan of, but once Keytruda gets rolled out, I'm sure it'll make a huge pop for their revenue. When I say huge, I'm talking about maybe like 3-4% growth in their numbers. Earnings per share, it should look good as well, right? 4,700% increase from their lows in 2023 of 14 cents of profits per share, 674. I think Merck, they're trending in the right direction with their financials, but take a look at their cash situation. I think that looks pretty good. I think out of the companies that we have seen so far, I think their balance sheet looks pretty solid. Pretty good, pretty good. Total debt, not too bad in relation to the cash on the books, but the better way is the debt to EBITDA. Yeah, 1.3. So their debt to EBITDA, pretty darn healthy. Free cash flow, take a look at this. Pretty good. $3.96. It goes down, it goes up, it goes down, it goes up. That's just the nature of the pharmaceutical space, because sometimes you have to spend more money for R&D or to get your drug published. You just have to pump more money. Aggressive research and engineering. Dividend profile, 3%, 43 payout ratio, 5% dividend growth rate. I think with Merck, it's not bad at all. I really like what I see. I don't think there was anything that was a huge red flag except their free cash flow situation, but I think that's just a commonality in the pharmaceutical space. Stock market history, I guess that could be the blemish. 30% in 5 years for what is considered one of the best bull markets. It's not good enough, but I guess it really depends. Because if you bought into Merck, I don't know, back in September at $81 and it popped to $104, you're probably a happy camper. I think the ROI on that is really good. But if you bought into Merck, I don't know, at the beginning of the pandemic in 2020 at $80 a share, and for it to be $104 now, not the greatest ROI. It's all perspective. But with Merck, I think there's a lot more goods than there were bads. Just my assessment. And then I wanted to talk about everyone's favorite pharmaceutical stock, which is Novo Nordisk. This is the parent company of Ozempic, the GLP-1 weight loss drug. And if you missed part one, then let me just remind you that the US government has it out for them. Maybe it's because they're not based in the US and this is a European company. Who knows? Their Ozempic is so good that they're being penalized for it. Like, straight and simple to the point, that's what I'm taking away from it. It's like, why are they being single-handedly picked on? It's kind of weird. Now, if you take a look at their performance in the past 1 year, negative 53%. And I know there's a lot of people that's been pumping Novo. I've been watching it, and I just ignore it. So I'm like, dude, you guys have no idea what you're talking about, do you? This thing has the potential to free fall down to $20, maybe even $15 a share. Because there were people pumping this stock in the beginning of the year at $80 a share. They fell down right here at $58, and people were still pumping it, and they fell down even further. And it just keeps dropping. And that's because when you look into Novo Nordisk, they're just having setback after setback in their drug and research pipeline. They were so close to GTM with their Alzheimer's drug Evoke, but in phase 3, it was considered a bust, and that just happened on Monday. So Novo Nordisk, they just can't catch a break. Like, obviously Ozempic has a huge customer base and a demand, but all of their other drugs are just getting setback after setback. And you know, I talk about it all the time. With the pharmaceutical space, your pipeline is your future revenue growth driver. So if your pipeline is failing and is disappointing, that means your revenue is going to follow suit. So all that to say, if we jump on over to their financials, and by the way, this time I remembered, to mention it, the currency that you see here, it's not in US dollars. So it's not 315 billion. It's in Danish currency. So whatever the heck DKK is, okay? But I can still understand numbers to see the percentage change. So I think that's what's going to be more important, right? Growing 31% year over year, 25%, 16%. So it does seem like the steam is slowing down. And to confirm that, we can break it down to a quarterly basis. And it's going from 30% down to 19%, down to 12%, down to 5%. Now, I'm not a gambling man, but if I had to make an educated guess, I would assume that the revenue growth is now going to slow down to 1% year over year, and then maybe even into that negative territory. Because you need to watch part one to understand that the US government has it out for Novo Nordisk. They have a target on their back. They're going to make an example out of them, but it makes sense because the American pharmaceutical companies, I feel like the current administration and the lobbyists and whatnot, they're going to look out for them. But for a European-based company, I think they're going to be the hitman. I think they're going to be the ones that get whipped and in trouble for everyone, if that makes sense. That's not financial advice. That's just my educated guess. The earnings per share situation looks pretty darn good. I would argue out of the pharmaceutical companies that we have taken a look at, I think it's probably the best. I'm not going to lie to you. The revenue slowing down, though, is a red flag. Cash on the books, pretty good. 32 billion, whatever DKK is. Total debt seems alarmingly high. But to confirm that, let's take a look at the debt to EBITDA. a 0.6. So it would take them roughly 7 months of their EBITDA remaining the same to pay off all the loans on the books. So that just tells me it's not too bad. Free cash flow, it's dropping. Negative 11%, negative 15% year over year. It looks like they reached the climax in 2023 of 83 billion DKK. Now it's down to 65 billion, and it seems like it's going to continue trending downwards because the revenue is also following suit. And I'm sure they're probably pumping a lot more of their free cash flow into their pipeline because they need an answer. They need to buy out a smaller pharmaceutical company or get one of their phase 1, phase 2 drugs to phase 3. And to do that, you're going to have to pour more money. There's no, or get some luck in your favor, right? Obviously, luck plays a huge part. Now, I do like their dividend profile in that the growth rate is 20%, 2.5% dividend yield. But what I don't like is that the dividend is paid out every 6 months. Because as a dividend investor, don't you want to be able to reinvest the dividends that are paid out back into your portfolio? And to be only do it every 180 days? The compounding effect of that versus like a weekly payout or a quarterly payout, not the biggest fan. And I think this is not really common, at least here in the US. Semi-annual, biannual dividend payouts, not really a thing. It might be a European thing, but I would argue if they were to pay it out every 3 months, I think more and more people would take a look at Novo. Actually, a lot of people do look at Novo, and I know for a fact there's a lot of bag holders. But I don't think their drug pipeline looks promising. And with their current drugs that are crushing it, the United States government is just, they have it out for them. Because in other countries, I'm certain that their Ozempic, the price to buy it is probably, the profit margins are like, maybe like a 3, 4, 5%. But in the US, their profit margins, that's where they make their lucrative free cash flow. But the United States government, Medicare and whatnot, they're paying less for it. So the profitability of Ozempic here in the US for them, it's shrinking. And their potential revenue too. So I think for Novo, it makes a lot of sense of why they're selling off. But a part of me, it's hard to agree with this valuation. Their PE being a 13 and their forward PE being a 12.7. I guess it kind of makes sense because their revenue and everything else is starting to slow down at a pretty aggressive pace. But on the other side of that argument, even prior to Novo Nordisk having a miracle unicorn drug of Ozempic, their 10-year average, their PE ratio is a 26.6. So when you take their stock price and divide it by their earnings per share, a 26.6 to be a 13, it's kind of like, it makes me almost want to say that the market's being really harsh about Novo. Because who is to say that they're not going to be the next Eli Lilly and get a crazy return in the next 5 to 10 years? As of right now, I don't see a bright future for them, at least for the next 365 days. Unless they have a drug that goes to phase 3 that's going to be a phenomenal value add to society, I just don't see rainbows and sunshine for them. Alongside with Bristol Myers Squibb and Pfizer, I mean, some of these other ones are also struggle boating right here. So all that to say, what's my game plan after taking a look at the pharmaceutical stocks? Once again, I don't really like them. It's really a gamble as to which drug or pipeline is going to see more success than the others, because Eli Lilly in 2025 is the beautiful, sexy, immaculate company. But who is to say 5 years from now, they're not going to be Novo Nordisk, right? Having said that, if I had to invest into one, I'd probably go with Eli Lilly. And that's why I give them an A+. A close second, J&J and maybe Merck. For Pfizer, a D+. I think Novo Nordisk, they're just getting a really harsh treatment. Because, based on what I see, they're an average pharmaceutical company, slightly above. But to be punished like they're in the F tier, it's kind of harsh. But would I invest into Eli Lilly? No, I would not. Just for fun, if I had to pick one, that's the one that I would go with. At its current valuation, absolutely not. It's the same reason why I'm not buying into Costco at $1,000 per share. Now, if Costco comes down to like at $500 or $600 a share, and they're trading multiples like an 18, 19, or even a 20, remember, they're in the business of selling household essentials in a warehouse. But to have a PE ratio of like a 50, 55, even though their numbers are only growing at like a mid-single digit rate of like 4, 5, 6% year over year, I can't justify the premium for Costco. Likewise with Eli Lilly, I think if they were to be shaved for what they are right now, all else being equal, if they were to be shaved down to like $700, $600 a share and their PE ratio was like a 25, 26, then I think the decision would be a little easier. But to be $1,100 a share and the trading multiple to be like a 50 whatever, there's just no way, Jose. Now, if you want to know why I would never invest into pharmaceutical stocks and you want more elaborate thoughts, then go and watch the video that I upload talking about it. Okay? I think it's well worth your time. Anyways, I hope you and your family and your loved ones, or just you, if you're just by yourself, you have a fantastic weekend and Thanksgiving. My Thanksgiving, what I'm thankful for is you and you guys for supporting me on the channel. You allow me to do what I love. So thank you for supporting me. You guys are in my thoughts. I'll be praying for you. I love you. I'll talk to you next time. Okay? Peace. And I also wanted to give a dedicated shout out to Ray for contributing towards the diaper fund. Thank you so much. By the way, yes, she did in fact have another blowout yesterday. It seems like to be a daily occurrence. So I'm going to be completely transparent with you guys. I did not expect for something that weighs, 7, 8 pounds to be pooping that much, to be going through so many diapers. That's, I guess, a first-time parent thing that you learn as you go. But anyways, thank you.